Hello, everyone, and welcome to the next episode of Mortar and Margins. And today we're going to be talking about, apart from anything else, banning institutional investors from owning property in the United States. But we're going to get on with the January sales and what's available and why you should consider buying property when everybody else involved in it is considering selling it.
So, Adam, I know on this podcast you like to be a little bit counterintuitive, but today you are in defiance of all of the received wisdom about 2026, which is a year to get out of property. So, why are you taking this contrarian view?
Well, apart from anything else, I'm just difficult by my very nature, Duncan. You've known me a long time, so you know that. But ultimately, I do believe very much in the phrase, if you do the same as everybody else, you're going to get the same results. So ultimately, the government have been fairly clear over the past 10 or 11 years now, regardless of who's been in charge, that you need to go big or go home in the property owning game. Interest rates have normalised, compliance costs are through the roof, operating expenditure is through the roof, risk has gone up apart from anything else. Now, any sensible investor knows risk goes up, you need better returns. And I think better returns have been coming from rents over the past few years and are going to continue to be coming. And to the victors, or maybe I should say, Duncan, to the survivors, will go the spoils apart from anything else.
Is this shaped by your view of the general property market, or do you think rental properties are going to move in a different, independent fashion?
Well, I think from a capital perspective, from a capital values perspective, I always look at what the open market does because that defines 80 to 90% of the transactions, right? So that pretty much determines the price. The 10 to 20% that can be investment money can obviously sway prices, especially in specific areas, apart from anything else. But the prices are really set by retail punters. And the retail punters are doing okay. You know, the mortgage rates are very steady at the moment. They're approving about 65,000 mortgages a month for house purchases. Aside from anything else, that's been steady for months and months now. Things are more affordable on paper for first-time buyers than they have been for many, many years. So it's been a very slow process while the interest rate has normalised in us getting to that stage. But that's ultimately where we are today. So I think now, aside from anything else, average first-time buyers putting down about 80 grand in their deposits. So first-time buying is not for everybody. And I actually think that whole debate is framed very, very badly when it's had in the press, because obviously that 80 grand could go somewhere else if you've got it, or whether it's come from bank of mum and dad or wherever it's coming from, that needs to be in the discussion. But that's another topic, Duncan.
Yeah, I'm gonna bring you back to the one we were on. So you said go big or go home. What constitutes big? When do the economies of scale start to make this business viable in today's world?
Yeah, great question. So the regulators see 4 or more properties as a portfolio landlord. The way the most of the data shakes down, they look at 5 or more properties. Obviously, apart from anything else, 5 properties in a very cheap area in the northeast of England is not the same as 5 properties in Mayfair. So, of course, I've got to say that. But people do generally look at how many properties someone has got. I would say when you start to get into double digits is when you're starting to see economies of scale. And for me, it was when the group was at 40 properties that we started to be able to consider having our own letting agency, which offered us lots of new opportunities as well. Both in terms of leads and in terms of control of management, apart from anything else. And they tend to carry on up to about, I'm led to believe, up to about 2,000 to 2,500 properties under management, under ownership, asset management. Obviously, at that level, you're probably dealing with multiple business partners, institutions, venture capital backers, private equity, things like that. But your economies of scale go up until about then, because apart from anything else, you might have one master asset manager who can look after those 2,500 properties and make decisions on a day-to-day basis.
So the secret is being able to bring some of these services in-house so that you're not paying kind of bits and pieces all over the place to external providers. Is that right?
Yeah, I think you've got 2 points of there that are worthwhile. I think number one, you're not paying someone else's margin in their business other than anything else. So that's obviously a bit of an advantage. And number two, you've got a higher degree of control over the asset base. So if you've got that level of control, you can be defining, apart from anything else, what the protocols are in-house. There is obviously a bit of a conflict between any business and its customers in terms of doing things as cheaply as possible versus doing things as well as possible, you can take that conflict out if you control the management arm of things, of course.
And will the discount change then that you're looking for to take on properties this year, given that we know that it is going to be less lucrative, there is going to be more risk with regards to not being able to remove tenants, with regards to the end of fixed term tenancies, things like that. So does that change the way that you look at what a property might be worth to you rather than to someone else?
It absolutely does. And apart from anything else, when of course there are fewer people on the buying side of the market, price comes down anyway because demand and supply works in the typical way that it does. But yes, we will be looking for extra discount this year. Extra risk that we're taking on. If we're buying a property with a tenant in situ, a few years ago, we wouldn't have been particularly worried if, let's say, there wasn't a perfect record of the gas safety compliance or there wasn't a perfect record of the electrical compliance. In this market, we're much more concerned about that because that might well affect our ability to regain possession. It might well be there's a court case in the future, a rent repayment order, or that sort of thing that might come up. There may well be solicitors or paralegal solicitors pushing these no-win, no-fee style solutions on tenants when the Renters' Rights Act is enforced. So risk has definitely gone up. So therefore, rewards need to move up accordingly. And with fewer buyers, as I say, there's definitely more ability to be at a keener price on entry-level property, definitely.
Okay. And do you have a target for where you want to get to this year in terms of properties? I mean, you say this is an opportunity for buying. Are you putting your money where your mouth is and actually taking that risk?
Absolutely. So apart from anything else, for the last about 5 years or so, we've refreshed some of the portfolio every year. So got rid of some units in locations we're not so keen on anymore, or units that we think are probably worthwhile getting rid of because over the next 10 years, they're going to take a lot of capital investment in the structure of the building, which we aren't going to see an immediate rental return on. So looking at refreshing some, which also then creates equity, creates deposit funds apart from anything else. So we'll be hoping to buy into the 3 figures worth of units this year, Duncan, and maybe dispose of about 40 or 50 in order that the debt position doesn't get any more aggressive than it already is.
So that's a 10% increase in your portfolio then in terms of number.
You're looking for more than a 10% increase. You're looking to grow about 15% this year, and I think we should be able to pick up the units because it's not like when renters' rights kicks in, it's going to be the end of the buying window. In fact, it might be that it ramps up around then. Let's just see how aggressive some of the councils and how aggressive some of the legal people get in terms of taking it out on the evil landlord, Duncan.
It means I'm going to have to keep updating my description of why you're an important person to talk to, because the 500 plus properties are just not going to match you anymore. But that's a problem we could deal with when it happens. Let's move on. So, Adam, I was asking you this week what we should talk about in terms of the news, and I suggested, I think, a couple of things, and you said, no, we need to talk about America. We don't usually talk about America because obviously we're in the UK and it's a different market, and, you know, there's some quite, let's say, unusual parts of America at the moment. But you said you wanted to talk about this, which is Donald Trump saying that he doesn't want institutional investors to own single family homes. He's under pressure really to show that he is tackling the affordability, the cost of living crisis which they have in America. I mean, on the one hand, he seems to be trying to distract away from it. On the other hand, he seems to be trying to take measures that would address it. And I just wanted to highlight on Reuters, they have this chart which shows, you know, who does own properties in America, and 1 in 5 homes, that's 14.5 million. So investors between 1 in 5 homes have got 14.5 million homes, and there are about 345,000 homes which are held by organizations which own more than 1,000. So actually that's the kind of level where you say you're going to be approaching in the not too distant future. So why do you think this is such an important story that we need to talk about on here?
Well, I think there's 2 things really going on that I think it'd be worthwhile understanding. So the first one is that I think Trump came into power and he said, right, what's one of the problems we've got? The interest rate is too high on mortgages. Now, I might be out of line here, Duncan, but I'm not sure that he understands all the nuances of the bond market. In the US, it's the 30-year money that sets the price of mortgages because they tend to fix for 30 years. The UK is the anomalous place. We have 2 and 5 year mortgages. That's unusual compared to the rest of the world. There are parts of the rest of the world that have 100-year mortgages, aside from that, multi-generational mortgages. We've got this 2 to 5 year system that seems relatively entrenched, for better or for worse, generally speaking. So I think he came in, beat his chest a little bit and said, right, how do we get this down? How do we get this interest rate down? So, from what he said to the Federal Reserve, he's basically tried route one, which is get the interest rate down, folks. And the most sympathetic central banker he can find, Stephen Mirren, who's currently on the committee, is only willing to vote to cut rates 0.5% rather than 0.25% when the Fed does a cut, because there's no real serious pathway down to 1% interest rates again without there being a significant economic meltdown. And I think he's finally got his head around all of that and thought, right, okay, so route one in terms of me just telling them to cut the rates isn't going to work. So he's come out with these couple of things this week. Alongside this, also buying up $200 billion worth of mortgage-backed securities, which should, apart from anything else, put the price up and the yield down. Who exactly is doing that, I don't think is particularly clear yet. But of course, the other way to control this, he thinks, is to squeeze the institutional players out of the market. And of course, that would have an impact. But Blackstone were fairly quick to their own defense this week with a 10 or 11 point defense when Mr. Trump revealed this plan and said, apart from anything else, they own 0.5%, as you've kind of just illustrated with that graph. We're talking about 0.5% of the single family homes in the US, 1 in 200. What sort of level of difference is that going to make at 0.5%? And the answer is none at all, really. So I think it's a fairly typical Trump maneuver. I think one of the smartest things I've heard said about him since he came back to power was, you don't have to take him literally. In fact, it's not a very good idea to take him literally, but you do have to take him seriously. So this is the point he's trying to make. He wants single family home ownership. He wants a return to the values of the 1960s, 1970s, perhaps the early 80s, which is a little bit ironic, really, when you think about it, because that's when free market economics really kicked in the US society. And this isn't, as you would think, this is not free market economics. This is banning certain players or threatening to ban certain players. I think what he probably is hoping for is that they continue to divest. But Blackstone have been divesting since 2022. Of course, they've been divesting because the interest rate model has changed apart from anything else, and they want to put the money somewhere else. They don't point that part out, of course. But single family homes haven't been necessarily the greatest investment, although they have gone up a lot in value. The US market, as you said, is very different to the UK market, whereas we've struggled on values, certainly over the past few years from a capital values perspective. The US values have gone up like a rocket.
Yeah, I was actually going to ask you that. But from a tenant's perspective, is there a difference to being in a property that's owned by an institutional investor in contrast within a property that's owned maybe by a mom and pop landlord or maybe a smaller investor?
Yeah, I think there's a couple of significant differences that we should discuss. Number one, you're always going to be subject to whatever the rental increase policy is of the institution. Mum and pop landlords are a lot less likely to keep putting rents up all the time. Now, they may well have been putting rents up quite a lot over the past few years because of interest rate adjustments, but that's much more likely to have an impact in the UK than the US. If mum and pop landlord has got a 30-year fixed rate mortgage on that property, it's probably, if they owned it before 2022, it's probably still sitting there at a very nice low interest rate. So people don't tend to like or enjoy the part of the idea of squeezing the tenant till they pop. Whereas the institutions just have a policy. They're a corporation. They have a corporate policy. It goes up every year. And then the same would go on anything like rental arrears or items that are arguably or definitely of tenant fault, apart from anything else. The institution will have a strict policy on how they deal with it. Mom and pop landlord might just send mom or pop round with the tool belt to fix something out and not worry too much about whose fault it was in the first place. So I can't imagine it's a greater experience, although that flies in the face of most of the governmental logic in the UK and the US, Duncan. But I don't believe if you asked 100 tenants and 50 were limited company tenants and 50 were mom and pop landlord tenants, I could pretty much guarantee the mom and pop ones would be happier than the other 50.
Okay. I mean, that's quite interesting because you would maybe think there's a bigger burden of regulation on the corporations, that they're more potentially worried about their image but I suppose you're saying they're basically just like more efficient, and that actually ends up being more painful.
Yeah, and I think you're correct in what you say, though. I think they are more concerned. I think they may well be hotter on compliance potentially and things like that. But my argument would be the average tenant doesn't care about compliance. Tenants absolutely hate it when you have to get access to do a gas safety certificate or an electrical condition report or an energy performance certificate or whatever, because they don't see the value in it. And I'm not saying there isn't value in it. I understand why the government wants those to be in place, but the tenant doesn't see transactionally, oh, great, I'm so much safer because I've done my gas safety certificate. If you ask a lot of landlords who've got gas boilers, for example, they don't necessarily service them every year, Duncan, because they're not worried about some kind of macabre disaster on their gas boiler that happens every 12 months.
Right. No, absolutely. Which reminds me, I'll get mine sorted. But can you translate this to the UK for us, Adam? Are we in a similar situation? I mean, could you imagine this happening over here? Is the ecosystem over here in terms of the ownership by institutional investors on the same kind of scale?
Yeah, even lower in terms of percentages. So we do need to qualify. This is talking about single family homes. Now in the US, they then segment into multifamily, apart from anything else, blocks of condos, things like that. There is a slightly different arrangement around urban and suburban living compared to the UK, but there are still plenty of single family homes out in the burbs and all the rest of it in suburban paradise. I wouldn't have thought, this is 10 and a half years of direction of travel of pushing rental property ownership into corporations and limited companies, apart from anything else. So it would be a complete reversal of all of that. Obviously, it does happen. I haven't heard Mr. Farage make any comments, who obviously would be the most Trump sympathetic person we should be considering in this situation, about what he thinks about this sort of thing. It doesn't feel very free market to me. As I say, it might be a take it seriously, but don't take it literally sort of job. But it would be a bit of a U-turn. Not that this government is allergic to U-turns, Duncan, as we know.
Okay, brilliant. Thank you, Adam. We're going to end up this week by talking about this fellow. Where is he? There. That's Warren Buffett, right? The Sage of Omaha, born 1930, which makes him, I think, 95 years old. And today is the first week in 6 decades, the first full week in 6 decades where he has not been on the top of the management of his investment firm, Berkshire Hathaway, I believe. So, very, very significant figure in the top 10 richest people in the world still. Son of a congressman, kind of famously paid himself $100,000 a year for about 40 years, which, I think you were talking about mum and pop landlords not raising the rates, but, that is definitely a guy who's kind of, got a 30-year mortgage and, my costs aren't rising. I don't need to take a higher salary. You are a big fan of his, I believe. Can you just, give me an idea? What do you take away from his time? Is there something that you do in your work which you feel is influenced by his mantras and his behaviors?
Well, I've definitely channeled the amount of research and that sort of approach to investment that Warren has taken over the years, and tried to use that for myself to try and keep informed.
That you're on first name terms with him, by the way. I think that's great.
I feel like I certainly feel like I know him, but then that's social media for you, apart from anything else, I guess, Duncan. I've watched many hours. I've probably listened to more Warren Buffett than I've listened to of my own wife, but don't let her know that, apart from anything else. But yeah, I do feel very much like I have a good insight. I think, mindset is the thing, and you kind of touched on it there with the $100,000 a year salary, lives in the same house that he bought back in the 1950s or whatever, doesn't need more. I saw him give a great talk once where he said, look, we have a very similar sort of lifestyle. I drive around in my car, I do this, I eat at Wendy's or I eat at McDonald's or whatever. I drink a Coke. Okay, I do have a jet. And that is pretty different. But when I need it, I have to get on the jet. But of course, Berkshire Hathaway haven't done a lot of M&A activity. They haven't done the stuff. They've got this huge cash pile, which lots of people are interpreting as they think that stocks are overvalued apart from anything else at the moment, and they're waiting to swoop. It could arguably be, of course, they've just got so big they haven't got anywhere to put the money. So I can't identify with all of that side of things, unfortunately, Duncan. But what I can identify with is his advice to be able to sit on your hands and not get bored. I think apart from anything else, for entrepreneurs, for investors, it is easy to get bored. It is easy to want to switch things up, trade for the sake of trading. Frictional costs in property are huge. The only thing that I'm aware of that we materially disagree on, myself and Mr. Buffett, is he's not a huge fan of real estate as an investment, although he has made money in the past in property. He prefers business. He prefers, and you know the sort of businesses he prefers. He prefers businesses like Coca-Cola or McDonald's that are kind of ubiquitous and are going to be everywhere. And famously didn't really like tech at all until he went into Apple in a very big way, because he couldn't resist the cash flows they were throwing off apart from anything else.
But you know, he is, you know, like you, a long-term investor. You know, he's still been doing this till he's 95. I don't know whether you'll be doing this till you're 95, but I think you would often say that is, you know, that is the key to being a good investor, is to be not thinking about, you know, how can I make money tomorrow or how can I make money next year, but how am I going to make money, you know, in 10 years, in 20 years, that's going to make, you know, a serious difference. And I think that, you know, that is certainly something that you would embody, I guess.
Absolutely. I think, you know, when you run an investment company, the balance sheet is more important than the P&L, right? And most people don't really get their head around that, particularly if they're used to running trading businesses, which is all about the P&L, or if they're not getting their information incorrectly, they're managing it from the bank account sort of thing. Investment businesses, the balance sheet is what matters. The reason why I love property is because you should have underlying capital growth in behind you, and also be able to squeeze out a bit of operational margin sort of to keep the lights on aside from anything else. And that's one of the key factors in it. But, you know, Warren's idea of retirement is to become the chairman rather than the chief executive. I hope I am still going at 95. Well, definitely one of the things I've taken from him is make sure you're doing what you love, because it's that old adage of you do what you love and you don't feel like you've worked a day in your life apart from anything else. So some fantastic lessons to be learned from all of his mantras, whether they're about investment or whether they're about life in general. Very pragmatic, practical individual who argues he's not that smart. I think we'd probably have to disagree with that, but he's followed a pathway. He's stuck with it. He's made mistakes, and he talks about those mistakes so people can learn from them. You know, he even says the purchase of Berkshire Hathaway itself was a mistake, overpaid for it aside from anything else. But it's incredible to see what he's built and the philosophy that he's worked within. And as I say, the mindset that the man has is something I think we can all learn something from.
Right. So round of applause as Warren Buffett bows out.
Person of the year.
So that brings us to the end this week. Please, if you do want us to talk about something particular next week, put it in the comments. We're very open. You know, me and Adam often on a Friday saying, you know, what do we want to talk about this week? If you want to influence that conversation, let us know, let him know. Otherwise, we will be seeing you 8 a.m. next Saturday, bar any monumental, you know, catastrophes. Thanks for joining us.